Mainly the luck is just that this all happened on a Friday. The skill part is identifying that there's a chart pattern, knowing what is possible, like understanding like the setup, the big picture of like where we are in the chart and reference, and then also the big picture is.
Welcome back to the show, everyone. Today's going to be a great day because we're going to be diving deep into a strategy with my man Mike Huddie here, and it's one of his favorites, and it's one he teaches very, very well. So Mike, welcome back to the show, brother.
Hey Alex, thanks for having me. Always a pleasure to be here.
Absolutely, man. I love that. I love to have you back all the time because I know you like to dive deep into things. So let's dive deep into the whole idea of the first red day.
Absolutely, my favorite setup.
Absolutely, let's go.
So where do you want to begin?
Let's begin with the whole idea before we dive into charts here.
So the first red day essentially is capitalizing on people's greed, okay? You have different psychological moments baked into charts. And essentially what happens is when you get a hot runner or a hot stock, novice traders or retail traders, or can't really tell you exactly who, but they tend to continually buy the stock no matter how high it goes. At some point, the hype overwhelms and the valuations mean nothing. And what that does is it brings in a lot of volume at all the wrong prices. When too much volume comes in near the top, what you get is eventually gravity. Gravity takes effect and you get this very drastic pullback. Now, does that pullback mean that the stock is dead? Absolutely not. It's just it's a stock that's recapturing or reclaiming or reverting back to the mean is like the common vernacular you hear, but it's really just a stock consolidating, finding that true balance of where buyers are going to meet this overwhelming supply of panic selling. And so being able to identify these psychological points in a chart bring about the aspect of a first red day. That's the big picture.
Okay.
It's really just capitalizing on greed.
So is there like an idea of like, is there any key statistics you need to see, like in terms of like how much it's run or anything like that?
Not necessarily. It's all relative to what the stock has done in the past. So if the stock has, you know, X percent like average true range per day, it just moves at this like constant amount. When it's not interesting, when no one's really trading it, it's going to have just average days.
Right.
When it becomes in play, when it becomes hype, it's very different. The price action changes. So you're going to have bigger candles. You're going to have more volume because it's in play, because there's hype, because there's some kind of catalyst, whatever it is. And then what I'm looking for is these candles to even get bigger and bigger and bigger. So I want the range to expand. I want the price action to speed up. I want the volume to grow. I want more and more people to come in at all of the wrong prices because they think it's going to the moon. And that's what's going to indicate to me that we're nearing a top.
And part of that indication of that we're near a top, is there anything that you're specifically looking for? Because if it just keeps going higher, how do you prevent yourself from like just constantly
getting chopped up?
Yeah, getting chopped up.
Like trying to cherry pick the tops.
Exactly.
So a lot of what I'm looking for is some kind of trend break. So one of my favorite aspects, and we'll get into it, one of my favorite aspects is when a stock starts gapping every day consistently, because I know the one day that it doesn't gap the same way that it's been gapping before, say it gaps up 10%, gaps up 10%, gaps up 10%, then that one day, all of a sudden it gaps down 10%. In my opinion, that is a behavioral shift. And that's maybe a day that I'll look to attack a stock. Or maybe it's going up every single day and it's not gapping, but there's a perfect trend line for 5 or 6 days. Someone's been accumulating the stock or supporting the stock, and then one day it breaks that trend. Well, maybe there's a lower high that I attack afterwards, risking the highs. It's always usually with a set risk. I'm never trying to be that guy that's just cherry picking tops. I really want to have rules in place that define, hey, this means I can get in. I need to see this, this, or that in order to want to actually be involved, because then I think that the play is not just cherry picking a top. Like we've had indications of breakdown.
We have triggers, right?
Sure.
And what I'm curious about is the idea of, you said you have rules in place, excuse me, you have rules in place that you don't just want to just short it, you want to see some type of shift, right?
Yeah.
But the other part of that is, do you have rules in place for your stops? Like, is any idea, or is it just more of it depend on the chart, or just curious?
I generally like to know my stops before I get in the stock. So I'm either risking like the previous day's high because we had a change in behavior and I feel like the previous day was the top. Maybe that previous day the candle was like super extended and there was a lot of volume. We call it an exhaustion candle. And at that point I want to risk those highs and saying that, you know, if we come back and break those highs, that's probably still a front side move. But if we stay below those highs, then I think backside, this could be a lower high on this daily candle. And then we can fade off because it's backside and people will eventually realize that they're in at too high of prices. And in that kind of case, I do have a previous resistance level to base my risk off of. Now, is it going to hold perfectly every time? No. You know, everything's kind of a weird science. Everything's kind of a moving target. You're never going to be perfect. But we're trying to identify the risk levels before we get in, not create them as we're poking at the stock and it keeps going against us, right? That is the exact opposite of what I want to do.
What would be, because that sounds like a mistake, if someone's trying to learn this strategy, that's like definitely a mistake someone could make. What would be like the main mistake to avoid or any caution to anyone that's trying to learn this type of strategy that you would give them?
Well, I think you nailed it, which is you can't be cherry picking tops. You can't just come in and say, oh, this is day 4 and it's been gapping for 4 days. Like, I'm just going to short it just because. There really has to be a structured trade plan around it, and you need to have those rules. So I think always when I'm getting into a plan, that there's 3 things I have. It's, you know, what's my trigger? What is my indication that the play is now valid? What is my risk? You know, what am I sizing into so that I know how much money I'm going to lose by the time the play is done? And then what's my patience level? Am I looking for some kind of quick drop? Am I looking for some kind of swing play? I want to have those 3 things mapped out before I get into the trade. That way, once I'm in, I can even set hard stops. I'm not afraid to use those. I love them actually because sometimes I don't trust myself. I generally give plays 1, maybe 2 shots, but I don't want to sit there and fighting the stock. Once it breaks my risk, I'm already like, hey, I'm wrong. It shouldn't be breaking new highs. A lot of times I feel like newer traders, that's the conundrum they get themselves into, where they pick a risk level, stock breaks that risk level by just a penny or 2 and comes back within, and they want to immediately get back in even though they took the loss 5 seconds ago at the exact same price. So there's no beneficial thing they're doing to their sizing, there's no beneficial thing they're doing to the play, they're just now fighting the stock. So I think giving up is a really good thing to do because there's going to be tons of these market dynamics that show themselves throughout my career. There have been hundreds, if not thousands of examples, some better than others. And realizing that one play is never going to make or break you is really important. And just moving on to the next. Like, this one's tricky, this one's a headache. I don't need it in my life. You know, it already proved me wrong. Let's wait for the next one that's going to prove me right, because there is one that's going to work.
Absolutely, and that's a good caution. Like, jumping right back in, because you hear the old adage of like, oh, you can always get back in, but it doesn't mean get back in right that second.
And I think there's a lot of old adages you hear out there about the trading world, and the ones that 90% of people believe, I think, are the ones that are wrong, unfortunately. And the whole idea where higher day stuffs and like you could just get back in, like especially to a novice trader that doesn't know how to read tape and really doesn't know too much, that's where a couple, you know, mishaps can really put you on tilt.
100%.
So it's dangerous. It's a lot of the adages you hear out there are more bad than good, in my opinion. And it's taken me 8-9 years of trading to realize this. I used to preach these things, you know. Now I know that some of them are partly reasons where I go through down spells or sideways action.
It depends the context of that, of what is said around that. But before we get off subject here, I'm curious on profit taking. Okay. Because, you know, we talked a little bit about stop, we talked about the big idea. But profit taking, like, is there any tips on this type of strategy when it comes to profit taking?
I think you need to know your data. And you can do this in 2 ways. You can either back test it through websites like Spiky, and I know people use like Polygon and stuff like that. Those are good ways if you can build out the logic in code form. Most people won't be able to do that. So the other way is to forward track, which is, you know, hopefully you're only trading 1 or 2 setups, so it's easy for that person. And you're basically, you know, trying out different things as you are going through the discovery phase. So like with first red days, a lot of the times you're going to have quick morning pulls, and a lot of the times those are going to lead to bounces, and then, you know, more fade is probably likely if you're looking at the right candle. So you got to kind of have to test and see, okay, over, you know, 50 to 100 of these first red days, which is going to take some time, and hopefully you're very specific and not blowing up an account while you're doing so. But over 50 or 100 first red days, you're going to see what your average gain is, what your max gain is, what your average loss is. And you can kind of start playing with that metric to say, okay, like if I short a first red day, I'm up 20%, 25% in the first 5 minutes of being in the trade. That's like my best, that's like my average gain. I've only been in the trade for 5 minutes. So that's probably a good place to take profits. Maybe if it doesn't hit that point and I think there's more downside, then I'm gonna be a little bit more patient and let it, you know, bounce, come back, fade, break the lows, and maybe cover up lower, because it really didn't hit the target that on average I see the stock goes to when it's set up like this.
Right.
So it's really about knowing the setup. And again, you can kind of back test it and see what is the average or max percent loss given a candle sequence leading up to this moment. Or what is my average percent gain? What is my average performance? I want to do at least average. I don't want to take profits too soon when the setup says like there's more downside. Does that make sense?
Yeah, it absolutely does. And you mentioned something right before we dive into the charts here, because I know people are like, all right, let's see what this looks like. I have one last question, because you mentioned like sometimes I'll play it once or twice. When you play it that way, are you thinking that ahead of time, and just so you're managing your risk, as in if I normally want to risk 1,000 per trade, are you splitting that into two because you're like, I might try twice?
Yeah.
Or are you saying, no, I'm willing to take 2 full-size losses?
So the hard part about that,
we cover a lot of information on trading here on Be The Trader, but none is more important than the broker you choose to execute your trades. There are many reasons I use Cobra Trading every day, including multiple order routes where I can get fast execution, great availability on locates for hard to borrow stocks, and fantastic customer service. But don't just take my word for it. Both Benzinga and Forbes Advisor have awarded Cobra for best in class for short selling and day trading. Isn't it time you choose a great broker that you'll enjoy working with? Sign up now by using the link below, and Cobra will provide you with free software for an entire month, plus 33% off commission for life. I know you'll be as happy as I am when you trade with Cobra. Now let's get back to the show.
the hard part about taking the second position is you have to be I think if you want to be a really good trader, you have to be very meticulous about your position sizing in that moment, because arguably a lot of the times, especially if you're doing the reattack thing, your risk reward is going to be better if you're closer to the top. So you want to have, so here's how I trade.
Yeah.
Let's say I have $1,000 risk, which a lot of the times I do.
Yeah.
And I have a really big account. And the reason that I have it down at $1,000 or $2,000 is because I'm more than aware to say there's going to be a day where I'm taking more than one trade. And maybe it's on the same setup, or maybe there's 2 or 3 setups that day. Mm-hmm. And I want to be in a situation where I can take all 3 mm-hmm. and not be in a situation where I've already lost too much and I'm scared to trade.
Right.
So even though my account, let's say it's at $400,000 or whatever it is, 200,000, if I'm risking 1,000 and I have to take 3 trades or 1 trade 3 times, I'm really risking $3,000 inherently, implied. And now it might only take 1 try to nail this one setup that day, but there's going to be other days where it's going to take more than 1 try, or there's going to be more than 1 trade. And so I want my risk to stay consistent, and therefore I want it small enough so that I have consistent risk, to answer your question. I don't want to do 500 and 500 because there's 2 plays or because I'm predicting 2 attempts. I never can know if my first attempt is going to be wrong. I hope they're all correct. Yeah. So I want to have full size, risk on that first attempt, $1,000. And then if it sets up again at a better price, I want to make sure I still have $1,000 risk if I think the play is still valid, because I don't want to cut my winners in half.
Yes.
I think that's detrimental.
A good point. Yeah, that's a really good point, man. So let's go ahead and dive into this chart here. So you want to go ahead and explain what you're about to show? Yeah,
so again, SMCI, we're going to talk about, you're going to kind of see, again, like the chart, the daily chart is a psychological representation of emotions. Okay, and you can quite literally see the emotions of greed coming into this chart, where you have a stock that, I always kind of reference the move from the breakout level.
Okay.
So let's say 350 to 200 is like this, what is this, 6-month consolidation period, and we broke out of 350, really nice breakout, and it starts to go on a run. And you think, 350 to pretty much 500 is already a great move. But then what happens? It consolidates, and it starts to break out higher. And in this, next phase of action, this is what I call choppy action. Okay? I don't really have a good read. The trend is not clear. And that's really important. When the pattern presents itself, the trend becomes more clear. It becomes more of like a sequence. In this, you have, stock that gaps up, closes red, then recovers, breaks new high, then has another indecision day, then shoots up higher. And so this is hard for me to read. I don't really know what's going on. I just know that it's extending and it's extending and it's getting somewhere where I'm starting to have focus. Now, before I go further, SMCI is obviously a $300 stock. A lot of what I trade are penny stocks. And the reason I trade penny stocks is because a lot of them don't trade on fundamental value, and they trade a lot more on hype because they're crappy stocks to begin with. So you actually see emotions in the charts. You see retail emotions in the chart much more clear. Whereas when you're dealing with bigger chip stocks, there are other players involved. Hedge funds and situations like that, where It's harder to read, but that still doesn't mean that retail can't come in, that hype cannot be present. We've seen it with bigger chip stocks. We've seen it with Tilray. We kind of saw it with Tesla, but Tesla always kind of choppy, just because there's other players involved. So it's kind of harder. So for me, as a penny stock trader, and really it's anything under $10 for me that I would be willing to trade, and it's more market cap based than penny stock.
Okay.
But I have known in the past that there are real companies like SMCI that do go through the penny stocking framework, that do get the retail attention, that get the hype, and then get the specific price action I'm looking for. So, it comes on my radar as it gets into the 500, 600s, but my mind is saying, Huddie, don't look at this stock. This is not your playground, but be aware that something's going on. Be aware of the AI revolution, be aware of NVIDIA, be observant. That's a really important thing to be when you are a trader. So I'm aware, I'm seeing traders take shots at it, but in this whole 600 to 700 area, I still think it's a bit choppy. Eventually we get these nice 3 green days right here in between February 9th to February 13th. Again, I'm not really taking a shot here because I'm really trying to ignore this stock. Principle first, where do I belong? Not in this playground. And we start to get better price action as we get into this range right here, but I still don't think we have extension on the candles. I don't think that the volume is necessarily extending. I'm not seeing exhaustion. I'm not really seeing any reason for me to come out of my playground yet to really say, oh, this is going to be something incredible. It gets incredible. And it's not necessarily all the chart that matters here. Again, being a trader is half being an entrepreneur, being a little bit creative, being a little bit aware and observant. So we're going to get into it. So we have these 3 days in a row that kind of is more clean price action. And then this day, which is probably a day that squeezed a lot of shorts because it kind of went red, or it started kind of as a gap down. So that situation that I explained before where you have 2 gap up days in a row, and then the behavior changes and the stock gaps down and immediately just rockets up. And it's like, nah, we don't give. We're buying. There's buyers. There's demand, right? And then these next 2 candles is where I start to get super interested, because now we're getting into a situation where the price action's starting to speed up. We are truly extended off this 350 level. Like, I even started to look at prior examples of big chip stocks that did start to extend themselves. Like Tesla was one of them that I started to look at because it did something kind of similar back when it broke out of 400. And even when it broke out of 400, like, it didn't go straight to 1,000. It actually took some time to get there. And so I was just kind of weighing the time, the length of time that it took for SMCI to go from 350 to 1,000 relative to Tesla from 400 breakout to 1,000. And I realized that SMCI was doing it quicker, was more extended. And again, so these last 3 candles, or it's really the last 2, where we get the bigger gap ups, the bigger range on the candles, and you can even see that the volume down here is starting to extend. And last but not least, we're getting into this $1,000 level, this whole key $50 type of situation where it's like 1,000. People either want to sell there, or the greedy people want to buy there. 1,000's going to 2. And that's the exact psychological moment that I want to take advantage of, because you have people who bought 350 who are saying 1,000 is a great price target to sell for a short-term top or whatever it is. And then you have the greedy people that are saying, I never got in at 350. This is going above 1,000. This is going to 2, 3, 4. It's going to go to the moon. And when you have those 2 players in one moment, the players that are buying at 1,000 versus people that are selling from 350, and then you add on retail in that moment, that's what can create the pullback, the big picture pullback. So we're going to play off all of these people's emotions. And preferably I don't have kind of a fight in the stock. Like, I don't have positions. I'm not biased one way or another. I'm just looking at this chart and I'm saying, okay, we have bigger gaps. We have extended price action. We have increasing volume, and we're approaching this big $50, whole dollar, $1,000 mark. So either they're right and 1,000 breaks out and it goes to 1,200, 1,300, 1,400, whatever those sayers are. Or 1,000 breaks down and it's a short-term top, kind of like a $10 or a $1 or a $20, right? Those whole $50 can be significant psychological resistance points, even if it's not on the chart. So you have 2 warring sides in this moment that either one side's going to be right, one side's going to be wrong. So we're going to talk about this day because this is February 16th. This is exactly the representation that we see so often when you have this sequence of, it's a pattern, it's a chart pattern, and it's reflective of human emotion. And when the people who are buying 1,000 saying that this is going to the moon, eventually have to panic and sell out, you can get what I said earlier, gravity taking effect. And it took such a long time for this stock to move from 350 to 1,000, and then you get this like 30% pullback in 2 days, because that's quite literally, no one's willing to buy up here. Everyone's willing to sell, whether you're long from 350 or you just bought 1,000, or maybe you bought 800 or 700, you're willing to sell at 900, and you don't want to be caught holding the bag. So you have this panic moment, this fear moment. And again, that's what we're trying to capitalize, that the big picture is the emotions. Now, what made this play so unique, and why did I come in on 2/16? Again, you can check my Kinfo. There's not a single trade for me on SMCI the whole run up. And there's a very specific reason that I come in on 2/16 and I say, okay, this is the day I want to try it. We've already gone over the chart, we've gone over the gaps, we've gone over the extended price action, the growing of volume, and the $1,000 mark. And all of that right there is enough to say, hey, Huddie, it's time to take a shot.
Yeah.
Maybe I'm looking for that first time it goes red, so I'm shorting, after it's red on the day. So, red would be the previous day's closing line.
Yeah.
So 1,000. So once it breaks 1,000, maybe I'm taking an entry there, risking the highs. Maybe it drops to 900, has a bounce, and I take that bounce, risking the highs, and I'm thinking maybe it has a 5 to 8% pullback from, the previous day's closing line. Like we get this drop. Obviously it went a lot more than 5 to 8%, but that's what I was thinking was possible given how the chart has set up in this very unique way. Now I want to segue, before I get into exactly what I did, into what my job is as a day trader. My job is to have a bread and butter pattern, which consistently makes me money, that consistently implores risk every day, every other day, every 3 days. I have some kind of risk, substantial risk on the table, and it makes me my daily income. And that stuff should be, like if you have that kind of set up in your wheelhouse, that should be every day, no thoughts, no questions, just do it, rinse, wash, repeat. The other side of day trading is hunting for unicorns, hunting for very unique scenarios that can really augment the bottom line. And those also exist, and you have to be aware, observant, and ready to attack those in whatever way that they can. And SMCI is a unicorn. And I want to tell the audience, tell you exactly why. Now, I'm not an options trader, but I did buy puts on this instead of shorting the comments. And for 2 reasons. One, it's a $1,000 stock. So in order to have good risk reward on $1,000 stock, so this stock's topped out at 1,075, right? If I want 1 to 8 risk reward, pretty good risk reward. If 1,075 is a top, I'm rounding, and I magically or skillfully realize pretty soon after market open that it's topping out at 1,075. I'm not cherry picking a top, which arguably could be saying I am.
Yeah.
But if I do get that really good entry of 1,050, risking 1,075, okay, a $200 drop would be about 1 to 8 risk reward. That's really good, but also entails, getting in at a moment where stock might still be going higher. Mainly if I want to get in towards where I have more conviction, that previous day's closing line, risk reward is shot, but win rate goes up. And that's kind of the dynamic you have to juggle in your mind. I came into this day saying, I don't want to play that game. What I did was on Thursday, the day before, and it's very important that it's Thursday, on February 15th, as it's going to $1,000, as it's looking very unlikely to break down on Thursday, I started to do some research about an hour into close. And I said, okay, when this goes red, I think it's going to have a 5 to 8% drop. I've seen first red days all the time. I think we're getting to this $1,000 level. I think it's going to be soon. I've seen all my best trader friends in the chat rooms, on Twitter, wherever, they've been taking paper cuts. Meaning in my mind, already there's a 50-50 chance that a first red day is coming any day now. Is it going to be, this is on Thursday when I'm looking at it. Is it going to be Friday for sure? I don't know, but it's 50-50. And the fact that I hadn't taken any losses at this point on the way up, and the fact that the chart looked as good as it was and where the price level was and everything we discussed, I said, okay, I'm going to give myself a chance to trade this stock. But I don't want to keep making the mistake that everyone's doing, which is trying to cherry pick the top. I want to give myself one opportunity, one shot to hit the stock. So Thursday, I started to construct my plan. It's actually very simple. I just want to explain it to everyone because I learned a lot. I'm not one that buys puts very often. In fact, I've only done it twice in my life. The SMCI was the second time, and the first time was Coinbase about 3 months prior, and when the ETF was coming out, and I learned a lot about puts in that moment, and I wanted to apply what I learned from that moment to this moment. And that's what happens in stock trading. Like what you learn in the past, you never know when or how it's going to affect your trading in the future. But stuff you learned 3 months ago might help you 3 months later. It's all these building blocks.
Yep.
It's really important to know. That's why you can't just show up one day and know how to trade. You really got to build it. It's cumulative. So Thursday, hour before close, I start looking at the options. And I say, okay, this is closing at $1,000. It looks like it's going to gap up. It's looking pretty strong on the day. If it doesn't gap up, that would be kind of a change of behavior. So either way, I'm looking at the options and I'm saying, okay, if it's closing at 1,000, and so I went on optionscalculator.net or .com. It's a pretty easy website. I'm a novice. Again, I don't know everything. And I'm checking, okay, if I buy a put and it goes from $1,000 to $900 before the expiration, right? Puts options expire on Friday. So I'm doing this on Thursday. So the time value of the option, there's only 2 days till expiration. I thought that was really interesting in terms of like the framework of where we are with the chart and then also where we are with expiration and options. This is the observant unicorn part where you really have to put the two together and think outside of the box. So I'm going in on Thursday and I'm saying, what are these paying? Like if this does have a 5 to 8% drop from 1,000, it goes red on Friday. I'm looking on Thursday and it says on Friday, if I bought the options at close that day on Thursday, and this goes to 900 on Friday, remember it said I'd make 500% of my money. So okay, that's interesting.
500%.
500%. And then I looked, I saw this other column where it said, okay, if it somehow goes today, I'm doing this on Thursday, remember, if it somehow goes from 1,900 today, and I'm doing this an hour before market close, so practically an impossible reality.
Yeah.
But if it happened on Thursday, I'd make 1,000%. And I think I actually clicked the button and then sold. Like I literally bought the Friday expirations and then I saw the Thursday, the same day was paying double. And I said, well, why am I doing this on Thursday? Why don't I just wait till Friday? And then I get that 1,000% premium because again, the time decay, the closer you are to the options expiring, the more money they're gonna pay you on your options because you have very limited time to be right.
Yep.
So I said, okay, there's no point in doing it on Thursday. Friday, gap up or gap down, in my mind, I said, I'm gonna play the first red day and I'm gonna give this one shot. And my risk was an option play. My risk was, this is either going to have another green gap up day and go to 1,400, do the same kind of range, the same kind of sped up price action, the same kind of volume, or it's gonna open, it's gonna reject 1,000 and it's gonna do the 5 to 8% dive below 900. And I want 5 to 8% dive below 1,000. And I want my puts, my strike prices to be 900, 920, 940. A very reasonable target from what I expect in first red days. It didn't have to be 800, didn't have to be perfect. I just needed to mimic what the options that I was doing the day before were. So that's exactly what happened. So Friday, I even made this in my watch list Thursday night. I said,
can you show the intraday chart real quick, just so people can see that?
Yeah. And again, kind of, for me, it really didn't matter about the intraday. Because I'll tell you exactly what I did.
Cool. So did you? Oh, I'm gonna guess here before you say it. Or did you risk basically the full option, like you were thinking?
Yeah, exactly. I was saying it was an asymmetric bet in its purest form. So this is kind of like the run up going into 1,000. This is the Thursday where I'm like, okay, seeing what the options can pay.
Yep.
And this is the Friday. And again, I wasn't watching this chart.
Okay.
Like on the intraday, I was looking at the daily chart because the daily chart gives me most of the context that I need to know. And it was an asymmetric bet. Either my idea was to buy the puts at the market open.
Yeah.
Didn't matter what the price action was. Didn't matter if it broke down. Didn't matter if it broke a low of day. Didn't matter if it broke VWAP. All that stuff that most traders probably would care about.
Yeah, sure.
I was just in my mind saying, today is as good as any day. I hate to put people under the rug, so I'm not going to say names, but like I know a trader. Pretty close trader to me, who was cherry picking tops and was down $13,000 on SMCI at this point. Let's not cry about that. He made 88,000 or something on this day that it went red, but he traded the comments. And he's already down 13,000. In my mind, I was like, I've taken no trades on it. I know that this is as good of a day as any other day, either from my experience or just watching the other traders who are also trying to nail the same move, already treating it like it's a 50-50 type of play. I thought it was better over 1,000. So maybe it's a little bit 51-49 type of idea. And the thing that really set it apart was these options, which are, this is a Friday. And I said, look, I kept saying this to people I was talking to on Thursday night, but I was like planning the trade, and I was saying, if God is in my favor, if the wind is in my favor and the sails are risen this day, then today will be a red day, will be that famous first red day. And if it is that first red day, I will either, the risk reward, the asymmetric bet was, if it stays green on the day and it has the gap up and continues higher, then I lose 100% of my option.
Yeah.
But if it goes to my strike price, I make 1,000%. So in my mind, it's 1 to 10.
Yep.
So I'm like, and I can see that. I can visualize the whole trade beforehand, and I've seen the math. I know that it's possible. So that's exactly what I did. At market open, I entered kind of, my normal everyday trades. And then once I was done with that, SMCI was at 1,070. It was at high of day. Did I know it was going to be a higher day? No, but I started to buy my puts. I started to just move over to, I was doing it on E-Trade. On the web-based platform, I have no idea how to really buy puts. It's not really I don't really need it for penny stocks. This isn't a penny stock. And I start entering my orders. First time ever doing this. And so in my mind, I said, okay, I want to start the day. I want to lose, what I normally like to lose on a given daily basis on one trade is $4,000. That's just where I'm at in my trading career. So that's what I wanted to do. I wanted to buy puts in the amount of $4,000. And today, if the stock is green, I lose $4,000.
Yep.
If it's red and it pulls, then I make $40,000, 1 to 10.
Yeah, great.
That was pretty much the math. Made a little mistakes on the way. We can talk about it, but it's not really important to the trade. But I essentially started to buy the puts at 1,070. And the long story short is, God was in my favor. The winds were in the sails, and the red day happened on Friday of all days. So a little bit of luck in this situation, but mainly the luck is just that this all happened on a Friday. The skill part is identifying that there's a chart pattern, knowing what is possible, like understanding like the setup, the big picture of like where we are in the chart and reference, and then also the big picture is what are the options paying? Because I think that's where it got really interesting in terms of like, oh, today is the day I want to give it a shot, and if it stays green, fine. Maybe I'll try again, on Monday or Tuesday, but Friday's the day I really want it to work. Because on Monday or Tuesday, if I take the same option bet, then I have to wait till Friday. It's 5 days. Yeah. So it's not going to pay as much as same day expiration. So I knew 50-50 setup, and if I'm right, it's a banger. Yeah. Okay, and that was really, interesting to me.
It's a great opportunity.
I made some mistakes. I came into the market open. I bought the puts on E-Trade, and apparently I had to be very specific to select which expiration, meaning it was Friday. And for whatever reason, E-Trade automatically selected the expiration for the next Friday. It wasn't that Friday. And I bought those puts first. So I had 6 days till expiration. And I started to freak out because I didn't notice it until the stock was at 1,030. And instead of just buying more puts and adding more size than the 4K I already had bought.
Oh, because you were already at 4K at risk at that point. Oh, shit.
No. And it was 6 days till expiration.
Yeah.
By the way, those still paid huge.
Okay.
But then I was in a conundrum where I was like, those aren't the same day. So I'm like cutting my reward in like, I don't know how much, but I knew it was bad.
Yeah.
So I'm on the phone with the trader at the moment. I'm like, what do I do? And he's like, I think you should sell, and I think you should buy same day expirations. So in between 1,070 and 1,000 price point, I bought like 3 different puts, different strike prices, 900, 920, 950.
Yeah.
And so I had to like go and A, kind of figure out how to sell them, which is pretty easy. And then B, I had to buy same day expirations. So I actually lost money on something like 30, 50 bucks. I wish I never did that. I wish I just added $2,000 more of risk and bought the same days and had like 6,000 at risk because, oh my God, the money would have been insane. But anyways, that's what I did. I sold all of the ones that I bought incorrectly from 1,070. So these were like 50 cents, 72 cent type prices of puts. We're gonna talk about where they went to at the end of the day. And then I rebought as the stock was at, I'm looking at the chart, as it was kind of doing this candle, 1,030, I remember at 1,000 even, I was like frantically selling the wrong puts and then buying the same day expirations. And before it really crossed 1,000, I had undone the accident and put in the right trade and lost on some, netted out. It didn't matter, that wasn't the trade. That was the mistake. And then I re-got my like $3,800 into the stock for same day expiration. And
it like
well, yeah, and then 10 minutes later it dropped to 900, and I knew so I'm looking on E-Trade and I have delayed quotes. And so I'm looking on E-Trade and it's saying I'm down 30% on my puts. I'm like, how am I down? This thing is down like, I should be up 1,000% right now. How am I down? And I remember like one of my entries was 72 cents and maybe another one was like $1.19. And I remember clicking in, I have delayed quotes because I don't really use E-Trade, right?
Of course, yeah.
So I click into my position to go sell and it gives me the updated level 2. And I see, I don't know how much volume, I don't really know much about options, but I see that the bid and the ask was like $10 by 15. And I panic, I'm like, I'm in from $1. This worked. Like I scream, I'm like, oh my God, this worked. I'm up like 1,000% and it's been like 5 or 10 minutes. So this was a mistake. This is also mistake number 2. I didn't know that once the options go in the money that they can go more in the money. I don't really know how options work, but I thought like once you hit your strike price, that's max gain. No. In fact, these puts ended up going up 10,000% in a single day. My $4,000 risk would have been like $450,000 and had I held till close. That was never the plan. The plan was to...
That's still close.
The plan was to cover where my strike price was because on my options calculator, that's as far as it went. I didn't see what was underneath. I didn't know I could have, let's go golf, close at the end of the day and have all day patience.
And if you knew that, I think you would have done it. Because
maybe.
Pattern,
I mean,
you would have at least a portion.
With a penny stock and there's dilution and it's extended for all the wrong reasons, I'm a little bit more willing to be patient. I know like Tesla itself was kind of tricky. On any first red days, like it didn't really stay down. Like demand can come back in. This is an AI stock. This is running on good reason. It's just overvalued now for all the wrong reasons. So it kind of fits, it kind of doesn't. But I still want to be proactive about making 1 to 10 risk reward. Those are move the needle type trades.
Huge.
Now maybe I would have waited, on some of them and not all of them. Maybe I would have waited till 880s, 850s. If I knew that the lower it went, the more money I could make. I kind of thought 900 was the ceiling. Where my strike price was the ceiling in terms of how much I could make. That was, again, kind of mistake number 2. I probably would have employed, I was out probably on these 2 first candles. Could I have waited 30 minutes, an hour? That I'm saying probably.
Could have.
Could I have, gone till end of day? I don't think I would have. Because at this point, I think they were already up like 3,000 or 4,000%. Like it's actually insane. And like when I think about the initial puts that I bought for the week, like for the wrong week, like those went up crazy too. I should have never sold those. Like those were the 2 mistakes. But anyway, so yeah, the 72 cent ones that I had specifically, those went up to $95 that day. Yeah, if you held till close. Like that's what's crazy. So truly a unicorn type of play. But again, the big picture is A, knowing what a first red day is, and then B, being the entrepreneur, being the creative, being the observant to say, okay, is there more to this play than meets the eye? And that's really the box that needed to be checked going in before Friday. And it wasn't like, oh, I see people talking about it on Twitter, now I'm doing it. You needed to know.
Yeah.
And that was the bet. Again, involves like asymmetric risk where it's like, I'm either right or wrong. Yep. But if I'm right on this day, which is as good as any other day, right? It's in fact better given where we were.
But even so, man, like, even if you just waited for some type of change in price action, you still, which you didn't intend to, but you kind of did, like on accident.
Yeah, I knew it was possible.
Still a great trade, even if you wait for the turn.
Well, I spent my whole life waiting for turns. I've spent my whole life shorting breakdowns.
Yeah.
So I just knew it was possible, and I knew I didn't need to be perfect with the options. That was kind of the beauty with the options. It was more either today it happens, so it could have gone to 1,300 first, and I could have been down like 99% on my options, but they wouldn't go to 0 unless the day ended. So it didn't matter if I had a parabolic spike at the open or not. It either goes to 0 that day.
I just learned something.
Or we go red. And I make bank. And I don't know if that changes. Like if it had opened at 1,000, spiked to 1,500, and then went to 800. I don't know exactly the difference there. I just know that I think I still would have made money. That was the whole plan. Either it's red.
Probably not as much, depending on how it closed and what time of day it did tank, because of time decay.
I think if I hit my strike, I think the thing is, if I hit my strike price on that day, then that's where I make my reward.
Gotcha.
And it didn't really matter how far it spiked against me. All that mattered is if it closed at my strike price or above my entry, pretty much.
And I know time. I don't know shit about options, so I'll stop right there. But what I will say is, I appreciate you sharing this, man, because this is I traded this and I didn't even look at options. Right. And now I'm like in my head, like, okay, now I'm ready for the next one.
Now I know,
now
right?
I know from this conversation. But before I don't want to go on a tangent here.
Okay.
I would love because I know people are going to have tons of questions. They're going to want to ask you more questions about this and learn more about where you teach and so forth.
Sure.
So could you let them know real quick?
Yeah, clovertrading.io. It's a community that we built with Kyle Williams, Don Mateo, and some other friends in the trading community that we've traded together with for 5-7 years. We've created a chat room where we give watch lists, we give trade alerts. This whole idea was written down in the watch list section on Thursday night, saying I'm gonna do something crazy. I'm gonna buy the puts at market open. I'm gonna do 900, 950, 5 to 8% strike. It was all written out. And I was just juiced on not only the fact that, you know, the people who subscribed were able to see that and then see the culmination, but then I was able to give webinars the next week and explain this exactly what I've explained to you to them. So that's where you can find us, clovertrading.io. Get in there if you want access.
Perfect. Well, thanks so much. And we'll provide links down below. And again, Huddie, thanks for being here, brother.
Thanks, Alex.